Have you heard the term cap rate, and are you only using cap rate to shop when it comes to your multifamily passive investment? If so, we're going to show you why that might be the worst thing to listen to and what else is important. If this is your first time listening, his name is Nate Armstrong. He is the founder and CEO of Home Invest. My name is Steve Warner. I am the Chief Investment Officer here, and you are listening to Purpose-Driven Passive Profits. This is our show where we teach you how to find great investments and be a great steward. We follow the idea behind Matthew 25 of being a great steward of what God has given you. Here we are. Nate, let's jump into cap rates. This is such a hot term. This is being thrown around. I know you and I have both talked to investors, and it seems to be all they care about, but really you need to be interested in your multiples, like what your exit multiple is, what your cash flow is, the deal overall. Why? Let's first define what a cap rate is and why that is not something that should really be a high priority when you're looking at a passive investment.
Yeah, so I'm going to go try to do, I got a 9-year-old son, Bianco. I'm going to go 9-year-old level. Bianco's probably beyond my level these days, but I'll still go 9-year-old level. So most people, when they're looking at an investment, they're going to look at what is my rate of return. If I go to the bank right now and I park cash in a CD, they might give me anywhere from 2%, maybe up to 5%. Some of the banks are getting aggressive. It's kind of funny. A year ago, that would have been 0.5%. Anyways, they'll give me that rate of return. So meaning if I park $100,000 with them at 2% at the end of the year, they're going to give me $102,000 back. So most people are comfortable throwing around that term rate of return. The reason that on multifamily specifically, we have something different called a capitalization rate is because on multifamily real estate, most people are using debt. They go take out a loan. There's a bank that's involved somewhere in the transaction. And typically when you apply bank financing in a transaction, you can create something that's called leverage, meaning you put $1 in and you can make that dollar work harder for you because your dollar multiplied using the bank's money too. So all that being said, capitalization rate, what it does is it removes the bank financing from the equation. So all the people that have different versions of what the rate of return would be on a property, like, hey, the rate of return on this building, if we have a loan, your rate of return is going to be 15%. But if we don't have a loan, it'll be this percent. No. Capitalization rate levels the playing field. It just says, you know what? We're going to take the debt out of the equation. There's no loan in this equation. What is the rate of return? And so that's the basis that we should start this conversation. So now that we have that established, now we can jump into the rest.
Okay, awesome. So now that we understand what a cap rate is, why are people like judging investments by it, right? It's really easy to hear like a 9 cap. Like if you hear a 9 cap, what does that mean to you, Nate?
Yeah, it means that it's a 9% rate of return without debt. If I put debt in the middle, I could probably make it even higher, but without debt, 9% rate of return. Why are people so hot on that? It's kind of a universal measuring stick. It's like, if we went to invest in the stock market and we found out that, this mutual fund is paying on average 7%, that's a universal measurement. Everyone understands what that means. So in the multifamily landscape, capitalization rate is a uniform thing across the board. The reason that you need to have that is because not everybody gets the same debt. If you get, one person that's a really high net worth individual and they've got awesome credit, they're going to get a cheaper cost of debt than the average Joe is. And so it's not a fair measurement when you get into the rate of return. So that's why we have to lean on capitalization rate because it removes the debt.
Okay, awesome. So now that we understand what it is, when people are shopping, is that I think that people see that number, they hear it and they're like, I want a 9 cap, or I want an 8 cap, or I want a 7 cap. And really that has nothing to do with the actual way the property performs. It doesn't have to do with your exit multiple. It doesn't have to do with your cash flow, but it sounds super sexy when you put it out there on the front end. What should people be looking at, and why should cap rate probably be number 4 or 5 on the list of things that they're looking at?
Yeah. Okay. I'm going to start by answering that question kind of in reverse. So the reason that maybe we should have capitalization rate as a consideration is only for the exit. And then I'm going to go back and talk about the other 3 you just mentioned. So what does it mean to exit? To me, exit means you sell the property. Well, how do you know what price you're going to sell it for? What it's going to be the exit price? We're talking about some date in the future. Like, we don't have a crystal ball, or do we? Well, here's the crystal ball, at least the best ability in which we can have a crystal ball. You can look at a market right now. You can go to any major market and you can look around and you can look at data that shows what other multifamily properties are selling at as a capitalization rate, cap rate. You can look at that. Like, as an example, the market of Lexington, Kentucky, where we do a lot of deals in, 5 cap is really good. When I say cap, it's the same as capitalization rate. A 5 cap is an awesome deal. It gets gobbled up left and right. There's tons of investors sitting around right now that will buy multifamily properties at a 5 cap in Lexington, Kentucky. Now, let's just say that we take said building. I'll just use the real terms. We've got a 49 unit building that we've agreed to. We're taking this thing. It's a smoking deal, all brick building. We've worked on it for a year. I'm really pumped about this one. We're buying it at a 5 cap today, 5% capitalization rate. We have a ton of room to increase the rents. The average rental unit in that entire building probably has at least $200 per month that we can push up. When we push those rents up to market value and hit actual market value, based on our current purchase price, our cap rate will probably jump between 7 and 8%. It will now be, instead of a 5 cap where we bought it, it'll now be like an 8 cap. And I'm just giving you estimated numbers right now. Now, when we go to sell that property, we could certainly sell it for the same price that we bought it for. We're not going to, but we could. And then it would be like a super slam dunk deal. Everybody and their brother would be coming after it at an 8 cap. We won't do that, obviously. What we're going to do is we're going to reprice it. So we bought it at a 5 cap. We raised it to an 8 cap. We're going to do, when we go to sell it to the next buyer, we're going to bring it back down to a 5 cap. How do you do that? Because all the rents are up now, you increase the purchase price. Okay, we buy it on the front side for 3 million. We turn around and sell it on the back side for 4 million. Pretty simple formula, but sometimes these terms get thrown around. It kind of sounds confusing. So Steve, tell me if I need to go deeper.
No, I think that makes sense. Like, when you raise the price, the capitalization rate is going to go down. We're buying it at a 5 cap. We're going to raise rents, which then allows us to raise the price. It will lower the cap rate back to what the market will absorb. This is the thing, guys, like, the cap rate in and of itself does not affect how much you are going to make out of the deal. It only affects what people will buy it at. And the only thing that matters to you there is that we are able to sell it at the end. So what really matters to you is, what is your multiple? So our buildings, we build the deal so that it gets you a 1.8x multiple. That's our plan. You put $100,000 in, you get $180,000 out when we sell it. The other number that you want to hear is what your IRR is. This is your internal rate of return. We aim for a 16 to 18% IRR. If we can perform that, that means, again, that goes to 100 in, 180 out. The multiple for the cap rate, all that does is let people know when they're shopping for properties what the property is performing at. Because it's kind of easy to understand and it gets thrown around, people are like, well, a higher cap number is better. I only want to invest in that. That really doesn't determine what kind of money you're going to make on the deal. All it has to do with is the sell rate. Does that make sense, Nate?
You nailed it. Thank you for K through 12ing it, as one of our friends always says.
That's all right. That's my job. If you guys would like to hear about the 49 unit building that we have, you can click on the link down below, or you can go to homeinvest.com. Right now, we are 70% subscribed on that deal. So we got just a few spots left, but we always have new deals in the work. If you're looking to invest with some solid partners, please reach out to us. We'd love to chat with you. Nate, anything that we missed on this episode about cap rates?
Yeah. So which is better, cap rate or cash flow? That is the question. Steve, what do you think?
Cash flow.
Yeah, I'll take cash flow as well. Cap rate's just a measurement for you to know and base your sales price off in the end. Let's look at the cash flow. Let's look at the equity multiple. Let's look at the tax benefits. If you want more on the tax benefits, go back to an episode that we did previous to this one. There's a lot of measurements that are important. Cap rate's a guide, but it's not the one that's putting the money in your pocket at the end of the day.
Yeah. All right, guys. He's Nate Armstrong, the CEO of Home Invest. I'm Steve Warner, the Chief Investment Officer, and you are listening to Purpose-Driven Passive Profits. We're reminding you to be great stewards of what God has given you, be a light in the darkness to those around you, and we will see you next time here on the show.